It's May already, but the biggest economic story of the year, inflation, hasn't changed. In fact, it's gotten bigger. Hi everyone, I'm David Scranton, and thank you for clicking on today's video. So yes, it's been over a year now that rising prices have dominated the headlines, and there still seems to be no relief in sight. In fact, the Fed's efforts to battle inflation seem to have increased the fear factor among many economists and investors. So just how bad could things get? Well, we'll talk about that and much more on today's show, entitled The Inflation Situation. Specifically, we'll cover where inflation stands now, what's driving it, how the Fed could actually make things worse, and how to help protect yourself if you're saving for retirement or if you're already retired. But first, let's talk about how bad inflation is right now and the many forces that are creating it. In March, inflation hit a 40-year high of 8.5%, and that was an increase over February. The core of the inflation problem can still be traced to the pandemic, because during the heat of the pandemic, manufacturing slowed and supply chains were disrupted. Then last year, once the economy started to reopen, demand began to surge as consumers who've been in lockdown were eager to get out and really spend again and to enjoy life. And the textbook definition of inflation is too much demand chasing too few goods and services. So typically you only need to increase demand or decrease supply of goods and services to create inflation. But thanks to the pandemic, this time we were hit by both. And we're continuing to feel the effects of both. Now, in addition to all of this, the other main drivers of inflation right now are spiking energy costs due to geopolitical situations like the Russia-Ukraine war and rising interest rates. The interest rate situation is particularly tricky and could lead to more problems beyond inflation. Here's why. Throughout 2021, the Federal Reserve took a very dovish view of inflation, meaning that they wanted to keep interest rates low, they wanted to keep stimulating the economy. They thought that inflation was going to be transitory. But it changed last October when inflation hit a 30-year high of 6.5%. Suddenly, the Fed went from being dovish to being hawkish, and in December, they announced a plan to start raising short-term interest rates steadily throughout 2022 in an effort to curb inflation. So right away, the Fed's new tone made investors nervous. Why? Because they agree with many economists that the Fed waited too long to address the problem, and that its plan now may do more harm than good. Why is that? Well, because raising interest rates might help slow inflation. In fact, the strategy by its very nature slows economic growth. That's the whole point, is to handle the demand side of the inflation problem. But if the Fed moves too quickly and growth slows dramatically, we could have another recession. Nevertheless, so far, the Fed has remained hawkish. And increasingly, that's raising concerns about a new recession and perhaps a major stock market pullback. Now, adding to those concerns is the fact that we've already begun seeing one of the classic warning signs of recession, and that is a flat yield curve. So the question you're probably asking yourself is, what can you do to stay on track with your retirement plan during this period of high inflation? Well, I'm going to break that into two categories. If you're not yet within 15 years of retirement age, your best strategy might just be to continue to put away as much money as possible in your retirement accounts. Take advantage of dollar cost averaging and try to get as much growth because time is on your side. Now, that could be increasingly challenging, but it gives you the best chance of beating the overall effects of inflation over the long run. Now, strategies to help you put away more money for retirement as these prices keep rising include things like looking for ways to try to minimize household expenses, even if they're temporary measures, because it gives you more money to save. Go through your monthly budget. Identify things that you're paying for that maybe you don't really need or that you haven't used often. Various subscriptions and or services. Review all your insurance plans and talk to your insurance agent about maybe how you can save money. It might have been years since you've done that. Now is the perfect time. Looking at consolidating debts to bring down the amount of interest that you're paying. Again, it might be challenging in a rising interest rate environment, but it's worth exploring. And of course, think about ways to increase your income. Are there opportunities you have to work overtime? Do you have a spare room in your house, or do you have a guest house that you could rent out? Do you have a skill that maybe you could parlay that skill, a hobby, into a side business? Every little bit helps. Now, let's take a moment and let's talk about how to deal with it if you're already retired, or even if you're within 10 years of retirement. First, be aware that even at normal levels, inflation hits older Americans the hardest for a whole bunch of different reasons. And neither Social Security nor most pension plans are keeping up with it. The Senior Citizens League estimates the average Social Security benefits lost almost a third of its buying power since the turn of the century. And a typical pension, if it does give you a cost of living raise at all, might average 1% to 2% per year. And right now, costs are raising at that rate every single month. So what can you do? Well, the best thing you can do is have a financial strategy that's flexible enough to both anticipate inflation and to respond to it. The key word there is strategy. And as I explain often, investing for income is much more a strategic approach than investing for growth. You see, an income specialist uses a variety of techniques and tools to help you keep pace with inflation and to even stay ahead of it. In addition, many income-based options can offer inflation protection. For example, some annuities can offer inflation protection. I bonds offer some inflation protection, and other things in the income world, like BDCs, like real estate investment trusts, can also give you a little bit of inflation protection. And what's more, an income specialist can often help you engineer an inflation hedge. How? Through the strategic reinvestment of interest and dividends that you don't need today. And now it's time to bring in today's guest. First of all, my good friend Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff, as usual, always great to see you.
It's so great to be here, Dave.
And I know you're excited because one of your favorite guests is here today, and that is our special guest, Steve Forbes, editor-in-chief of Forbes magazine, and also author of the new book, Inflation: What It Is, Why It's Bad, and How to Fix It. Steve Forbes, thanks so much for being with us here on The Income Generation.
Good to be with you. Thank you for having me on.
Wow, what a great topic, Steve, inflation. The Fed finally did it. They did $7 trillion of stimulus in 2020, both fiscally and monetarily, and boom, inflation was created, and you wrote a book about it. Now what's going to happen?
Well, what's happening is that the Federal Reserve finally realizes they have a disease on their hands. They got a real crisis on their hands after pretending for a year and a half that it's just going to go away. The amazing thing is, and we point this out in the book, which is written in a very friendly, jargon-free manner, is that last year the Fed, even though the economy is beginning to recover from the COVID lockdowns, the Fed still continued to print and create a lot of money. $120 billion of bond buying a month. How did they pay for those bonds? They paid for the money created out of thin air. Right. So now, as they say, the chickens are coming home to roost, and the Fed laid a big egg, and now it's scrambling to undo it. But I'm afraid they think the way you fight inflation is by depressing the economy. So I'm worried about an economic slowdown. These guys are guilty of economic malpractice.
Steve, it's interesting because, first of all, I want to know how long ago you and your co-authors planned the book, because that shows some really good foresight on your part, and why you thought it was so different this time that you needed to get together and write such a book.
Well, we started it a little over a year ago. I got the manuscript in the fall, but you know how book publishing is. It takes a while to go from manuscript to hardbound book in the bookstore or online. And so it was clear, we thought a year ago, that when the Federal Reserve was going to continue this bond buying, that there was going to be trouble. we point out there are two kinds of inflation: non-monetary inflation, which comes, say, you have bad weather, so you get a crops going up in price and that kind of thing, or a war like we're seeing in Ukraine, or the kind of lockdowns that they did during COVID, which severely disrupted supply chains all around the world and raised prices. But then you have the monetary kind, which the Fed can control directly. Even before COVID, David, the Federal Reserve was undermining the dollar. They were creating too much money, 2018, 2019. And they continued it in 2021. The government was spending like crazy, and the Fed was financing much of that debt. The Fed was an enabler. Now we're all paying the price for it.
No doubt about that, Steve. I'll tell you what, though, the Fed finally did it, so hats off to them on creating massive inflation, the worst inflation in history. It's impossible to inject $7 trillion into a $20 trillion economy and not expect rapid inflation, high employment, high consumerism. But they've set us up for a ginormous fall. Are we going to see a recession now because of all of this overstimulation?
Well, unfortunately, the way the Fed fights inflation is we're going to have a more economic pain. They are going to make the situation worse. The Fed believes that inflation is caused by too much economic activity. And so even though they don't say it, when they use words like, we want a soft landing, that is Fed speak for, we hope to slow the economy without too severe a downturn. But usually soft landings turn into crash landings. And so if I had more faith that the Fed knew what they're doing, I'd say we could get through this in pretty good shape. But I have no faith in the Fed at all. And they've done for what they've been doing so far. They raise interest rates, which is going to hurt the housing market and other things. At the same time, they're hurting the economy. One of the best ways you fight inflation, which Reagan did, is you have a vibrant economy. And that comes from less regulation, lower taxes, and lower spending, which this government is doing the exact opposite on all fronts.
Yeah, I agree that the government itself is not doing a lot. They've kind of left the Fed stand alone in trying to deal with the inflation issue. And at the end of the day, it's not the Fed's fault because it could be the Fed's fault because they acted too late, you can argue. But the Fed only has one tool, and that is interest rates to taper down demand. They don't really have a tool for the supply side of it, right? That's really up to Congress, is it not?
That's right. And on the Fed side, what they are doing is as you know, banks are now loaded, drowning in reserves. And so what you're going to see the Fed do is start to raise the interest they pay on bank reserves on deposit at the Fed to try to keep some of this mounds of money from flooding into the economy. And it's very interesting in terms of the games these people play. The key thing that economists look at for money supply in the economy is what they call M2. That used to come out weekly. Now that number comes out monthly. What do you think of that? Trying to suppress information.
Sure.
Not to be unserious about it, Steve, but I guess having faith in the Fed is like believing you're going to get honest news from CNN. And on that note, I pulled an article from CNN back in 2000, after the first quarter, when the dot-com bust still just started to happen, and they were glamorizing how earnings were going to be really robust and everything was going to be great at that time. I feel like we're in a 2000 moment all over again, but we're in 2022, and now we're at the start of the great unwind in asset prices. Give us your thoughts in that regard. Are we in the same position as we were in 2000?
Well, we're in the position in 2000 where we've had a very vibrant market, as you point out, and now we're in a situation where both stocks and bonds are in trouble. Bonds, obviously, with rising interest rates, that means the price of existing bonds go down. And in terms of the stock market, yes, I think the market's upside potential is, shall we say, limited. And I fear a downturn. And again, the way you fight those things is you stabilize the value of the dollar and you make it easier for people to do business with one another. What's amazing is the energy in this economy. You feel it in a free state like Florida, and people want to do things. And that's the way you cure these things. After the terrible inflation of the 70s and early 80s, we had a great 20-year boom until government wrecked it again.
Well, and of course, as you indicated before, one of the things Congress can do is have fewer regulations when it comes to energy, which would help us a lot right now when it comes to inflation. But the Federal Reserve can't control what Congress is going to do or what the White House is going to do. So what do you think the Federal Reserve should be doing with interest rates right now? Should they just...
What they should be doing is nothing. Let the markets set interest rates. It's amazing. We all sort of accept that the Fed should have the equivalent of rent control on money. You know, we call it borrowing money, but it's really renting money. And the Fed is putting price controls on it, which distorts the markets. We know that in the housing sector, less construction when you have rent controls. And the Fed is doing the same thing. So they should just let the markets, let borrowers and lenders settle on what the rent for the money should be. In terms of the Fed's balance sheet, they're bloated holdings. When a bond comes due, don't buy another bond, let that unwind. And they should then focus on the dollar, stabilizing the value of the dollar. And then they'll minimize the harm that's done to the economy. But I fear they're going to try to engineer a slowdown. And the idea you can control an economy of 330 million people by a handful of bureaucrats at the Federal Reserve is just so preposterous. It leaves me speechless almost.
Well, on the economy, Steve, things are starting to slow down. We're starting to see that, you know, and so where do we see the inflation tapering off? Because we know we're at 40-year highs for inflation. Things are priced to perfection right now, especially in the real estate realm. And are we going to see demand destruction, or are we going to see inflation kind of pull itself back in check before we see that demand destruction?
Well, that's in the hands, that's sadly out of our hands. We'd know how to fix it. But in terms of the Federal Reserve, they should not be trying to manipulate interest rates. Let the economy determine the amount of money it needs and meet those needs and no more. And we used to have a gold standard which worked very well despite what the myths of today. But even in the 1980s, late 80s, early 90s, Alan Greenspan sort of pegged the dollar informally, very informally, to gold or a basket of commodities. So that way you have some stability out there and let the economy take care of itself. And one of the things I'm hoping for after the November elections, if not before, is that Congress will take a very active role in rolling back regulations or not financing the government's obstruction of the economy. For example, they ballyhoo this great infrastructure bill, which, as you know, only 10 cents on the dollar on that bill was for actual roads and things like that. But no sooner was that bill passed than the Biden administration reimposed rules in terms of environmental rules and other regulations that are going to delay these infrastructure projects, tie them up in thousands of pages of studies and things like that. So they say they love infrastructure, they just don't want you to do it.
So, Steve, final thoughts. As a member of the income generation, what best, obviously you think that there's a high likelihood the Fed will create a recession of sorts. We tend to agree. So what's your average income generation member to do with their money to protect themselves? What's your best advice?
I would keep a portion of your money, not a lot, but a portion in gold, not as an investment, but as an insurance policy. I would look for stocks that have a good record of dividends and being able to raise prices. So you get income that even might rise during a troubled time. And bonds, I would stay away from long bonds. I think those rates are going to go up some more. And you get a feel for it. Look at the 2-year Treasury, which a few months ago was basis points. Now it's over to 2.5%. So I would be very careful there. Keep your horizon short. But the thing is, I think in the next 2 years, both with these elections and the 2024 elections, we're going to have a situation like 1980. We're going to set the groundwork for another zoom upward. When that happens, the economy will take off like an Elon Musk rocket. But in the meantime, have your hedges like in gold, stay short on bonds, look for good dividend stocks that have a solid history and solid cash flows.
Jeff Small, Steve Forbes, thanks so much for being with us here on The Income Generation.
Thank you.
Thank you, Dave. Thank you, Steve.
Thank you for watching today's video, The Inflation Situation. If you liked it, give us a thumbs up by clicking the button, and you'll essentially give us a like to make sure that you subscribe to our YouTube channel for new content each and every week.